Hey everybody, welcome to this free edition of our Traders Group Weekly Roundup for the trading week ending November the 8th, 2024. I'm Preston Brent. Thanks for tuning in. Well, the theme this week is a red sweep, markets blast off. I don't know how else to put it. It was just a clear, wild week, positive for everybody that's bullish in the markets. Let's just take a look at kind of what's working right now and what I think over the next couple of months going into the end of the year. You can see in the US, all index performance very solid. In fact, we made record highs in the S&P. We made record highs in the Dow. In fact, the S&P's gain this week of a little over 4.66% was the best in almost a year, going back to early November 2023. While the Dow's gain of 4.61% was the best weekly gain in over 2 years. And we've had the VIX, as you can see on the right-hand side of the screen, it was down over almost 32% for the week. That was a largest weekly drop since December 2021. So a lot of activity here. I think investors are basically waging right now that the Republicans capture the White House and Senate with expected retention of Congress, which is why they call it a red sweep, would result in faster earnings growth, looser regulations, lower corporate taxes. And I hear there's a number of other things out there that are risk oriented. We'll talk about them in a minute. But the initial reaction with the market was very, very positive. Okay. Also, a stronger US dollar might help offset some of the impact of tariffs when they're imposed, because we know that President Trump's going to throw those tariffs out there, while lower taxes and some of the deregulatory kind of initiatives that the Trump administration is going to put out there is going to support the economy. So there's a lot of cross currents out there. Nobody really knows for sure how it's all going to settle out until early next year when we get going in this thing. But just as a matter of course, the U.S. economy, the U.S. share of the world's market cap is at 60%. And the U.S. markets right now are currently 10 times bigger than any other country on this planet. That just gives you an idea of just how strong the U.S. economy is. In fact, I told our members last week, I had a couple of charts that showed a lot of money is flowing from Asian and European markets into the U.S. equity markets. But a lot of that growth, primarily since 2009, has come from PE multiple expansion, meaning money's willing to pay up and pay higher for future revenue streams. Okay. So that shows a lot of confidence in where the markets are right now. Now that may shift, but right now that's what the markets are showing. Finally, Nvidia has finally moved into the Dow, replacing a very long-standing member, Intel. They're now out of the Dow, but it does give the Dow a heavy dose of growth and AI exposure. Okay. You can see the PE ratios are, in my mind, really very elevated. Now the trend in the market is up, and you can have an uptrend with elevated PE ratios. But this is where I would probably side with Goldman Sachs. Now I don't know if I would be that um, low, but they came out and said the next decade the S&P is only going to see an average of 3% gains annually. I would probably be a little bit higher than that, but nowhere near what we've seen since 2009 of about a 15% average annual return in the SPX since 2009. So I don't see that. A lot of the money is going to be coming out of the markets, but what supported this market is almost zero interest rates for a long period of time and a ton of money. That's going to have to right itself, and we'll see what that does to the markets. I think we'll get gains, but it's not going to be like we've seen before. Doesn't mean we can't have big 1 year gains or runs of 3 months, 6 months, but I just don't see this going on at that pace much longer. Okay. You could see the VIX fell, as I said, 31.72%. It closed out the week under 15, 14.94. You can see the best sector is discretionary for the week, 7.51, worst utility. So it was not a red sector in sight this past week. Communication services is leading the way to the upside, over 33%. Materials bringing up the rear, and still a very healthy 11.86%. Okay. Now, the election pretty much overshadowed most of the market's economic and policy developments. I mean, we did see the Feds on Thursday cut their interest rates by another 25 basis points. And that's the first easing move since they cut rates 50 basis points in September. All right. But really, the week's biggest surprise from an economic perspective, everybody knew the Feds were going to cut. At least that was the market perception. Um, but the bigger surprise was the ISM services activity came in at 56.0, well above expectations. Was a lot lower than that. But that's the best reading we've seen in services since August of 2022. And it showed price pressures eased a little bit, even as activity picked up. All right. So, all in all, it was a very positive, bullish type of week for the US markets. And then, of course, if we go over to Europe, it was just the opposite. The Euro stocks, FTSE, CAC 40, DAX, all in the red. And the CAC 40 is in the red year to date. They're not doing nearly as good, right? I mean, in Europe, obviously, a lot of the worries are about the impact of a Trump administration on trade policies, on European economic growth, right? And sentiment all throughout Europe. So this is going to keep that index or those indexes across Europe in the red for a bit, right? In fact, the Eurozone composite PMI came in a little bit higher than expected. It actually came in exactly at 50. So it's almost like a stalemate, neither contracting nor expanding, okay? The early estimates were for it to come in at 49.7, but 50 is close enough to say they're really not going anywhere right now, right? Meanwhile, in the UK, we saw the Bank of England. They voted 8-1 to cut their key bank rate a second time this year by 25 bips. Now they're down at 4.75%. They're seeing inflation, like here in the U.S., continue to decelerate. Although I think we're going to get inflation readings this next week. I think we may get a surprise number back to the upside. That may spook the investors enough to move the markets just a wee bit lower. We'll see. All right. Now, if we look at the Asian markets, they're all in the green. The Nikkei investor risk appetite was supported by the outcome of the U.S. presidential elections. They like that. The Fed's rate cut, they also like that as well. And the yen appreciated a little bit based on the election. Market participants are speculating the Bank of Japan is going to raise their rates in January another 25 bips. So that may stop that downward slide just a little bit we've seen in the yen. We've had made some really good money in the yen so far this year. We're on the sidelines right now waiting for a really good low entry pickup for the yen. And then, of course, in China, the big news out of there, the stocks really, as you can see, China's up 5.51%. Hang Seng up a little over 1%. Year to date, they're good. All of that is due to stimulus. China came out and announced, or the PBOC, the People's Bank of China, came out and announced a $1.4 trillion US dollar refinance program for local government debt. That really moved the markets big time. That's a lot of money. But it looks like it shows the commitment of the Chinese government to really prop up their economy until they get back on their 2 feet again. Okay. Meanwhile, on a trade front, exports rose an above average 12.7% in October from a year earlier. All right. It was only up 2.4% a prior month, right? Now, while the growth in their exports signaled strong demand for Chinese goods, I would caution that it could be a lot of companies are sending stuff over before Trump gets in because they know Trump's going to jack up the tariffs. So they're probably shipping as much stuff as they can out of that country. So that probably was one of the reasons for the rise in exports right now. All right. So their economy is still in the consolidation phase, and it may be that way halfway through 2025 as well. So just understand what's going on there. But really, the shining star this week, clearly, no doubt, was the U.S. markets. Now, I want to take you over and let me just show you the charts here for a second. So let me just move off the screen here. I'm going to take you into the E-mini S&P 500 futures, and we'll just kind of quickly go through it just so that you can see what I'm thinking and just how the markets are sizing up. What does the Trump administration mean? Okay, you can see the E-minis here. We were literally leading up to the election on the 5th, you could see here, and then on the 6th, the markets really moved hard because Trump, it was a clear one. The big fear the markets had was that this would be drawn out for months, and legal sides, lawyers on both sides would be fighting it out, and the markets would be in limbo for several months. That didn't happen. In fact, Trump's victory was so decisive that they were able to call it early in the morning, and that was it. Right now, they still have a few races they got to call for the U.S. Congress, but it looks like the Republicans are going to take Congress as well. But you could see this big move. We hit my small pullback point. In fact, when I pulled back a little over 3%, I said the pullback would be 3 to 6% in late October, November timeframe. We only got just a little over 3%, not much more than that. And the markets held up until we got the election announcement, and then away we went. This was my next target, and we blew right through it. Now, typically with these bars, as you can see, the price action will generally move up to these bars. By the way, these bars are a combination of Elliott wave, i.e. an Elliott wave 5, which is where it ends that current trend progress. And then you go into an ABC chop pattern before it decides where it wants to go next. But it ends the Elliott wave process, the bar, and it also throws in there a combination of Fibonacci and Gann. But you can see it runs up to it, and it always finds a way to come back and retest it again. So I would not be surprised to see a little bit of a retest of this 59.60 area in the markets. We had such a strong week that the market, I think, may need to rest. I still think my target, I had changed my year-end target in the markets in the SPX to somewhere around between 5,800 and 6150. All right. The E-minis, I would look at just slightly south of 6,200. All right. But we'll see. It just depends on how the next economic data point comes out. And nobody really knows what the Feds are going to do in December. The markets are saying more than 60% chance, 67% chance they're going to cut the rates another 25 basis points. But I think they're getting to a point where, with the mad action in the markets, that price increases may start come around. And if we get CPI data next week that suggests inflation ticked up a notch, that's going to be enough to move the markets a little bit back to the downside. I still think we'll finish higher from where we are now by the end of the year, but between now and then, there's going to be some volatility kicked into these markets. Okay. If we come down here and look at NASDAQ, NASDAQ had a very strong week as well, and I haven't adjusted this one yet. It's the only one I haven't adjusted. But you could see the NASDAQ, that was the prior high that was made way back on July 12th. It came in and took it out, all right? And we moved up, so that put us around 25, 26% year to date. But I do believe that's going to pull back just a little bit too, all right? It's setting itself up to do that. But we'll still have a nice finish for the end of the year. And then, of course, if we come in here and look at the Dow futures, the Dow also made new highs. All right. You could see here new all-time highs. It was made on Friday, on November the 8th. This was an intraday all-time high, up 16.67%, 44,300. Right. And you can see how most of these indexes were centered around their 50 EMA, and then it came in and the election just moved it up. And I told our members the election, if it's a clean sweep, typically the markets are going to move strong, but it may pull back just a little bit. But we're going to see here in the next 90 days how the markets fare through January. And of course, if we come in here and look at the Russell's not at all-time highs. The other markets are. The Russell made a new high for the year. The all-time high is just sat slightly north. There's the all-time high, last made on November the 8th, 2021, right? And we're just south of that. I think we're going to take that out before the end of the year, right? If the Feds cut rates again, it's just going to continue to add to the market strength, especially the Russell, and you're going to see it move up, right? A lot of this is also with the economic growth patterns of what Trump wants to do, as well as less regulation. We'll see how this goes. Tariffs, it's going to be interesting to see how he plays that out and rebate some of that money that countries end up having to pay back to the American people. But we'll see how this plays itself out. If we look at the equal weight, that also made a new high for the year. This is, you could see here, we made a new high on Friday, moved up 16.69%. So that does show that there is support and breadth in the market, that other stocks are also worth a look, right? Because it's doing very well. If we do a ratio chart of equal weight to the SPX, those heavy market cap weighted stocks are still outperforming. You can see here it's moving down. So when this moves down, that means the markets are pretty much being run, even though all the other stocks are up, the top 10 are up a lot more, right? So that's a little bit about what I'm seeing this. Now, if we come over here and look at volatility, just look at how fast vol dropped. Like I said, more so this week in the past couple of years. You look at that; it's just off the table, right? It gapped up leading into earnings. I mean, into the election, and then it just gave it all up when Trump won. I think it's going to stay elevated through the end of the year. I don't think it's going to go into the green. And if we do get a economic data print that shows inflation is steady to going back up, I think it may introduce a little bit more volatility into the markets, and the markets may pull back just a little bit. And just to show you, if we look at the front month vol skew, you can see it's back in the green again, right? Just barely back in the green though. So the vol skew has even moved into the green, but it's a little bit closer than I would like to see. And if we look at the back month volatility skew, it moved much more into the green, right? You can see how much in the red we were. Now this is comparing the November and the December volatility futures contracts. And you can see the skew is normalized. It's in the green. And then if we go out to the 2-8 spread comparing December and June volatility futures, there is no fear right now going out in time. So the markets are pretty much keen on 2025. I think there are a couple of potential landmines out there that could really upset everybody's apple cart, primarily the US deficit. Members will spend a little bit more time on that in our weekly market watch tomorrow evening starting at 7 p.m. Okay. Treasuries, if we look at the treasury market, you could see the bonds, interest rates have been just floating higher. You could see after the election, the initial reaction on the election was to sell off, meaning interest rates went higher, and now they're coming back and stabilizing pretty much where they were right before the election. But interest rates are a lot higher than where it was back in September, right? You could see that big downdraft in the bond market, which means interest rates have been moving higher. And we may get a cross in the 50 and the 200 if we don't get a big move up, which tells me that interest rates are going to stay higher for longer. And that's going to kill the real estate market with mortgages, right? Because if we look at the 10-year, which is where the mortgage industry generally plays off of for their interest rates, it's the same. It's off the table down, which means interest rates are straight up, right? So that's going to hurt the real estate market. Now, if we come down here and look at currencies, if we look at the US dollar, no doubt the dollar is just, the strongest pig in the pen right now. It's up very strong. In fact, we're coming up and challenging the 2024 high that was made in the early summer months. You could see the dollar was getting low down here in late to mid to late September, and then it just took off. Europe is starting to falter. They almost went into recession. Germany was probably in a recession, didn't know it. Came very close either way. But now the dollar's up strong against the euro. And of course, if we look at the Japanese yen, you can see the Japanese yen is going to start to bottom here. We're going to start looking at another long opportunity, but just not yet, right? And then, of course, if we look at the euro, it's usually the mirror image opposite of the dollar. So the euro is giving it all up. I mean, the euro was about $1.12 to the dollar roughly. Now we're sitting down here around $1.07 to the dollar. So it's just come down. It's getting close, like the dollar is to the highs for the year. The euro is getting close to the lows for the year. Now, my target for the euro has actually come down a little bit lower, right? Which would mean the dollar is going to move up just a little bit. And then, of course, if we come down here and look at gold, how did gold settle in? Well, gold came down on the election, right? I mean, you could see here, gold does not pay interest rates. It doesn't pay interest or dividends. It's a fear hedge. I think gold is, I'm using a buy the dip opportunity in gold. I think longer term gold will be good, but you could see that we had a sell trigger on gold back over here on October 31st. It said, just take your profits, get out of gold for the time being. If it breaks the 50 EMA, we'll probably come down and test 2614 area. And then we may go a little bit lower, but I would be looking for a buy opportunity in gold, right? I mean, that one to me makes sense. Same thing with silver. Silver is off their highs, and now it's just barely below the 50 EMA. You can see where it's holding up here. I think it's going to come down probably and touch the 200 EMA. Right? And then finally, if we look at the energy markets, you can see oil was down hard on Friday, um, right like this. And I think oil is probably going to eventually come back down and test these lows that were made over here on the September the 10th. All right. In fact, there's an Elliott wave pattern here that would suggest oil can come down here all the way down to $58 a barrel. Would not surprise me at all, right, to see oil go that low. Nat gas, I want it to go even lower. I want it to come down here. I said any rally should be sold at this point. But I think it can come lower, and then you could see that if it does this, we're going to be looking for a long position in nat gas, just not right now. All right, everybody, that's kind of our quick and dirty on some of the major indexes across the asset classes in the U.S. market. Strong week. Be real interesting to see how inflation comes in next week and where the markets want to go. Okay, remember, we're stretched, but we can stay stretched for a while. But eventually it's going to snap. I don't see a snap at this point in time unless something out of the blue happens, but we're going to see the markets a little bit of a dip, I think, would be in order in this month as we round out November going into December, more than 3%, and then a little bit of a strong finish to the end of the year. All right, everybody, have a great weekend. Members, I'll see you Sunday evening for our weekly market watch. Take care, folks.